Hi there. I'm going to do a quick run through on the basics of cash flow, particularly as they relate to All-Star. And I'm going to do this in what's often referred to as an unconventional way because it doesn't follow the way that accountants do it. So I'm going to start off with my list here of what's titled 5 sources of cash in a business. So number 1 on the list is cash from operations, and typically what we're looking at there is the operating profit and with some adjustments for depreciation. The second component is working capital, and here we're looking at changes in the debtors, stock and creditors. Under investments, the third item, we're looking at cash from selling assets. That's where you get it from, but you need cash in order to buy assets, and what this is in fact measuring is the cash that goes out or comes in from buying assets. From financing, we might raise new debt, that's cash in. We might pay off debt, that's cash out. And of course interest payments are an outflow of cash. And for shareholders might give us new equity. We might buy some shares back from shareholders, in which case that's a cash out. And paying dividends to shareholders is a cash out. So as we assess a business's cash flow, we assess it in this order, asking ourselves which of these are cash in and cash out. Now that being said, let's go to All-Star. I've created a list here, or the headline for a list, where I'm going to list the cash in for All-Star, and then I'm going to list the cash out, and then we're going to go and find the numbers to put in here. So to start off with, I'm going to put in the cash inside. I'm going to put in the operating profit, since I know in the story or in the numbers that they made a positive operating profit. We're going to do some adjustments for depreciation, so I'm going to put that in here, and I'm going to explain that in a moment when I actually do the numbers. The other thing that brings cash in to All-Star is they go and get some new debt. Go and borrow some money from the bank. I think it's about R1 million, and that brings cash into the business. Then on the cash outside, what they do is they go and buy some new assets. Their debtors increases and their stock increases, and I know that an increase in debtors is cash out and an increase in stock is cash out, and I'll explain those when I get the numbers. What else was cash out in the case of All-Star? Well, they paid some interest expenses because they borrowed some money, and a cash out was the dividends that they paid to the shareholders. There was one other cash out, and I'm simply going to type that in here. That was the taxes that they paid. And you'll see that the taxes are not in my sources of cash list because typically we don't receive tax from SARS unless we've already paid too much. So that's why it's not a cash in. So let's go and find some numbers. We are looking for the operating profit. We're doing the cash flow for the second year. Let's go and find a number here. So I'm going to head off to the income statement, and what I'm looking for in the 2018 year, I want that operating profit. By using this number in our cash flow, we are taking into account all of these items that have come before. And one of the items that came before was a deduction of depreciation that we didn't actually pay to anyone. It just represents a use of the asset. So therefore, if we didn't pay it, we must add it back in order to find out the actual cash from operations. So let's push enter to get that number in there. Then we're going to add back the depreciation number of 252, and the result there will be 1.4 million. Let's go and find out what new debt they got. So to find the new debt, we're going to go to the balance sheet and we're going to see what happened here from one year to the next. And clearly you can see this went up by $1 million. So you should be getting the difference here. You're actually saying $1 million minus 0. But since there's no debt from last year, we can say that this is R1 million, and if you borrow money from the bank, that is a cash inflow into the business. Let's tidy some of these up by putting in some formatting here, and then what I'm going to do is I'm simply going to say let's add that one and that one together to get a total cash in, if you want, and we will just tidy it up like that. Alright, so we've got the cash ins. Let's go and find the cash outs. Now they bought some assets. How much did they pay for the assets? Well, the story told us that we paid 1.2 million, but we should be able to go back to the numbers and find that amount. So let's go to the balance sheet, because that's where we're going to find the assets. And you can see here that the fixed assets went from 450,000 to 1,125,000. If we buy assets, it must be an outflow of money. So we want this sign to actually turn out to be negative. So the way to get it to be negative is to say, we'll take that one and subtract that one. And what do we get? Well, clearly it's not 1.2, so therefore our calculation must be incorrect. So we need to make some adjustment here. So in fact, we've also got to take the depreciation into account when we buy these assets. So let's delete that for now and let's come back here. This value is the value at the end of 2018, and this value is at the end of 2017. So from this year to this year, we have deducted depreciation off these assets. So therefore you can't simply compare the values in these different timelines. You've got to make an adjustment for the depreciation. And that's what this calculation over here does. Effectively it's saying, take E14, which is my value here, add back the depreciation so that I take this value so that it's at the beginning of the year, and then subtract the assets that I already had, and hence you get the 1.2 million. So we can come here and say, for now, let's just put this in here as 1.2 million. We don't need to have a sign on the front of it because this is our cash out list. So all of these in fact are negative numbers, they are outflows. Alright, moving on to the debtors. So remember what debtors are. They are customers who owe us money. So if the debtors goes up from one year to the next, it means our customers owe us more. Let's go and find this number. The debtors has gone up from 482 to over R1 million. The increase in that number is over R500,000, and that there represents the outflow of cash because our customers are taking longer to pay us. Alright, so let's use that number. Now I don't actually want it to be negative in there, I want all of these to be the same, so I'm simply going to put a negative sign in the front of that and just tidy that up. There we go. So now we know that our customers taking longer to pay means they've got the money and we don't, and hence this is cash out. The next item is the stock. And the principle here is if your stock levels have gone up, it means your cash has gone down. So we're going to go back to the balance sheet and we're going to have a look what's happened here. Clearly our stock has gone up, so therefore our cash has gone down by that amount there, which is the difference between the two. And I don't want this one to be negative, so I'm just going to adjust that there. Okay. Now why are there no creditors? No creditors in the cash in, no creditors in the cash out. And the reason for that is the creditors from one year to the next remain unchanged. Therefore, there is no cash flow effect from that. So I left it off the list. Interest payments. Well, here we're going to the income statement. What's the interest payment in this here? There it is, interest paid. So remember, we've calculated the cash effect up to operating profit, but there's still a few items here, interest, taxation, and dividends, that we must take into account. So there's the interest. Now let's go and get the dividends. There's the dividend amount, and then the tax amount is there. Okay, so you would have noticed with all of these three items, they came from the income statement, therefore I used that number. If the number came from the balance sheet, then I had to compare last year's balance sheets with this year's balance sheet and get the difference between the two. What we've done now is we've got all our cash out items, and I can ask Excel to quickly sum those up for me. Let's put that over there. And now we have the cash in and we have the cash out. So why don't we simply say cash in minus cash out? That will tell us the net, should we call it the net cash flow? How about that? Net cash flow. So over the year, the cash was reduced by 50,478 Rand. Well, the obvious question to ask is, what was the opening cash number? Let's go and find that. The opening cash must be the closing cash from the year before. Balance sheet, year before, closing cash. They had no overdraft. Closing cash, there it is, 43408. All right. Now, if you start the year with 43,408 and 50,478 flows out, what are you going to be left with? You're going to be left with negative 7070. Now, I noticed some questions in the forum about where does that number come from, what does it mean? Now's the time to go and check on what that is. Negative 7070. Let's go to the balance sheet, and you'll see I have that number there. And if I ask Excel to tell me what that number consists of, it consists of the cash and the overdraft. It's the net of the two. So remember, in our cash flow, we did not take overdraft into account. Let's just check on that. You see there's no overdraft here. So therefore, the number that comes out the end, which we might call the closing cash, must be the net of the cash and the overdraft. So hence we get this 7070. We could, if we wanted to, have put the overdraft component in here. So if you get an overdraft, that means cash in. So we could come to the cash in list, and we could have put here overdraft, OD, and that number would be equal to that one. Let's get rid of those arrows so that overdraft would be equal to that one. Enter. Now we need to make sure that this is added into the formula. Alright, so let's see what's happened. We obviously have some extra cash in coming into the business. So therefore the cash in number's gone up, minus the cash out. We've got a different net cash flow. The opening cash flow doesn't change, and now when you look at the closing cash, that number 35,260 matches that number. Isn't that awesome? So it depends which way you want to do it. If you want to incorporate the overdraft in your cash flow, or if you want to leave it out, then you get the net cash at the end. Now what the accountants are doing is they are taking this cash in list, they're taking the cash out list, and they are shuffling them together like you would shuffle a deck of cards into one deck. And what you get is then this series of positives where it's cash in, and negatives where it's cash out. And all those same items, stock, debtors, creditors, remember that's zero, fixed assets, debt, interest paid, dividends paid, tax paid, all the same items where the bracket represents an outflow and the positive represents an inflow. And I've added in these 5 different sources of capital down the side. So really this list that the accountants produce as a cash flow is a cash in, cash out in a different format. Hope that helps. See you in the next one.